We have 5% of US GDP running through our buildings, which is a tremendous amount of just the US economy. And I think that's what's super interesting. You walk into a building, it's not the building you're looking at, it's not the concrete walls. It's an entrepreneur. It's a really interesting business that has some competitive advantage over others.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor. We have a wonderful guest who's been on before, Brandon Page. Brandon's the Executive Vice President and head of all of leasing for Link Logistics, which is a very large industrial owner and developer. So Brandon, it's great to have you on the show again. Thank you for joining us.
Absolutely. Thanks for having me back on. Appreciate it.
Before we kind of get into some of the questions of what's going on in the industrial space, talk a little bit to us about how you rose the ranks in your career path and what you do for fun and, outside of work as well.
Yeah, absolutely. I sort of joke I've been in industrial long before it was cool. I've been in this field, I guess, 20 some years at this point, but I was with Prologis for a decade and multiple leasing roles, kind of worked my way up to, market officer for the Bay Area, and left at that moment to join Blackstone in their original platform, Encore Properties, which ultimately sold to GLP. Link was formally formed in 2019, but we actually started buying assets. I was employee number 3 back at a company to be named later that ultimately became Link in 2019. And, since then we've grown to just north of 500 million square feet. Today we currently serve 10,000 plus customers in 3,000 buildings, all just US based. So it's been a great run and, lots of, never a dull moment, that's for sure. Along the way.
That's
amazing
awesome in 5 years. My gosh.
Yeah, I was going to say it has been awesome though to just see like the industrial space become like the coolest kid at the party, because we are now, the industrial world is awesome.
It is. And I think what's interesting about it, at least from my perspective, is it is in a lot of ways a commodity asset. It's 4 walls and a roof. And so a lot of what we think about a Link is like, how do we differentiate Link and how do we, provide, like leveraging our scale to provide access to whether it be data or services or goods that they otherwise would be buying. And so it's sort of like building that relationship, being really a trusted partner, all those things that sort of differentiate what otherwise is a commodity. And then, at the end of the day, these are all 10,000 individual different companies. A lot of them are small businesses. They're entrepreneurial. It's sort of the heartbeat of America. We have 5% of US GDP running through our buildings, which is a tremendous amount of just the US economy. And I think that's what's super interesting. You walk into a building, it's not the building you're looking at, it's not the concrete walls. It's an entrepreneur. It's a really interesting business that has some competitive advantage over others that they are now, bring their families, they're supporting their employees' families through it. And I find that super fascinating. So it's really not the supply chain part is very interesting. The buildings are interesting, but it's really the underlying business and consumption and just the U.S. economy that I really enjoy about our business.
For sure. Before we dive into all the details of the industrial market, Brandon, just tell the listener a little bit about, what happens after work. What's the family life look like? What are you doing on weekend?
Yeah, I mean, it's safe to say that I'm spending all my Saturdays and some weeknights that I am home, including last night, coaching 11U baseball.
Love it.
I think usually on Saturdays, my wife coaches my daughter's lacrosse games. There's sometimes dance recitals. We've got a lot of home games this year, which is great. So it's a 9 a.m. first game, and then we get the doubleheader, which starts at 5 p.m. So other than a few hours in the middle, which try to get a mountain bike ride in or something, do, yard work, it's 8 a.m. at the ballpark, and you're there till 7 o'clock, getting home at 8. So that's sort of Saturdays. So it's fun. It's really fun.
You'll appreciate this, Brandon. So we have 4 kids, 3 of them are boys, and they all play select baseball, and they were in tournaments this weekend. So between the 3 boys, we had 15 games over the weekend to make. And so that was an eventful weekend. I hear what you're saying about spending a lot of time at the ballpark, which is awesome.
Yeah, no doubt. At least we're able to get some good weather finally turned here in Utah. So the mountain biking is getting good. Went for a great road bike on Sunday. And just trying to just hang on at this point.
Yeah, there you go.
That's impressive coaching, but I would have been really impressed if you said you were also coaching the dance recitals. Like that would have been
No, yeah,
No
we've
part of that. Yeah. We
Ah,
don't want that's that. I don't see Brandon fitting that space very well. Yeah.
no, I don't
that's
think
not
so.
my zone. That's definitely not my
Very
comfortable
good.
spot.
Let's talk about the boring stuff, the industrial. Let's talk, obviously, a different year, a little different. So let's talk about the leasing velocity in 2024. What are you seeing out there?
It's been slow, to be honest with you. I think,
Sure.
across the board, the first quarter was really slow. And, I think when we last talked, it was maybe 6, 7 months ago in Boise, we sort of knew this would be the time when all this new construction was going to hit. There's no surprise. There's a lot of new product coming online. We track very closely, all activity on both vacancies as well as renewal activity looking out 9 months. So it's a good barometer. You guys are really in tune into each individual market. We track our portfolio across the country, just get a sense of like, what does the demand look like? What the activity look like? And I'll be honest, like it was really consistently good. It was the
Mhm.
same as last year. It's still from like a tour standpoint, really, really strong. I think the big difference this year is that we're just not seeing tenants make a lot of decision. And it's not a case where the demand isn't there. There's a lot of uncertainty in the world we live in. So I think what we're really seeing today is that if you don't need to make a decision, you're better off just punting. And if that means
Mhm.
whether it's a year, we're just going to do a short-term renewal, maybe we take, instead of the 1 million square foot building that we really need to do this right, we're going to take a couple of hundreds to sort of band-aid, work on some of that kind of risk off safety stock, making sure we can deliver if we do have some sort of disruption somewhere. But, the days of leasing it and figuring it out later clearly are done. Like
For
they're
sure.
very methodical. There's a lot of emphasis on staying out of the C-suite. Like I said, if we can get smaller buildings that don't require the level of scrutiny from senior management, maybe we go that route. So that is great in the time of, a lot of these bigger buildings, and headlines are like, look, there's a lot of, net absorption's down, construction is sort of peaking in terms of deliveries between now and the end of the year. We sort of view that, vacancy will probably peak in the first quarter, first half of next year, just based on what's out there. And then, again, we've talked about this before, but there's a pipeline behind it that doesn't exist. So really interesting dynamic from an availability standpoint, potential for, better concessions, lower rates, whatever the case may be for a tenant to take space today. But really once that dries up, and your guess is really as good as mine is when all that's going to be absorbed. But, if we get back to sort of normal absorption, it's not going to be too long when there's just no new development behind it to support the demand. And that's obviously going to have an impact on rates going forward, which is a real boon for our industry.
Yeah. Tenant uncertainty is certainly a challenge right now and certainly real. Do you think the biggest challenge that you guys are facing right now as a firm is just dealing with that tenant uncertainty, or is there something bigger that you guys are facing?
Yeah, I mean, certainly from, from an absorption standpoint for increasing our occupancy, that's the case. I think, the reality is like supply chain networks are constantly changing, and, the cost of inventory has gone up, and obviously the warehouse cost has gone up, but so have transportation and labor. And so like everybody's always constantly struggling to find the right answer for their supply chain needs. It's different for every company. So it's really hard to pull out a lot of consistent themes, but I think a little surprised by the little bit lower retention. Obviously we don't have the velocity behind it to immediately take some of these spaces. And then there's that shadow vacancy that's been out there. So you hear, Southern California, you talk to 3PLs, which we do all the time, and they're as busy as they've ever been. And if you look like first quarter, their leasing was way off. But if you talk to them about their prospects for the second half of the year, much more optimistic. And they're, as they say, their hair's on fire. They feel really good about the new contracts that they're getting, which doesn't necessarily surprise me. We just need those groups to make decisions, pull the trigger, and we'll start to see that 3PL activity pick up here in the second half.
Yeah, I think that's right as well. You guys are a big company, right? And have control a lot of space. What are some of the reasons that a tenant would choose Link building over at one of your competitors? What are some of the things that you guys stand out with?
Yeah, it's a good question. We spend a lot of time thinking about, how can we best be a trusted partner? And that's really what it boils down to. We're a big national company, but at the same time, we're a local business. We have local people in every market. We empower our teams to run these as if they own them. And, we want to be trusted to honor our obligations, to get customers in when we say that we're going to get them in. We want to have our TIs on budget and on time, know that we can get through a lease process. We want to be trusted by, the tenant rep brokers that are repping them, that are putting their reputation on the line saying, yeah, this is not only is the rents market, that's fair, the building works, but you can trust Link to, to have a good experience with them. We're building, we've got, a little bit different on like the ESG side where we've taken back the meter. We've got our own internal utility program where we're buying power in bulk that we're able to pass on. We have an internal portal for tenants called Link Plus that allows them to have access to everything about their lease. Maybe they're buying goods and services they otherwise would, that we could help them. So we're working at building up a database of products, like a procurement side of the business as well, that is not intended to be a profit center for Link, but it's to help, frankly, just be an amenity for being in a Link building. And, the fact that we own 500 million square feet across the country and anywhere from 200 square feet to 1.5 million feet, we like to think that as your business changes, as your client's business change, needing more space, potentially multiple markets, that, we've got teams that are focused on just that, which is just really being an easy button, and kind of all circles back to that being trusted a partner and something every day.
Yeah.
That's great. So that's very interesting about buying power in bulk. I hadn't heard that either. With all the changes out there, we've got increased interest rates. Obviously, you mentioned tenant velocity down, construction prices still remain extremely high. How is Link focused on growing? Is it still acquisitions in capital markets? Is it construction? Is it both? What's the focus kind of over the next year related with growth?
Yeah, all of it. I think year to date, we bought maybe $600 million worth of deals. I think we're actively pursuing another $2.5 billion. On the dispo side, we think we're right around the $2.5 billion as well. Those are big numbers in the context of the size of our company. It's not, but it's sort of funny when you sort of throw numbers around like that, because they are really giant numbers. Our development pipeline, we've got 12.8 million square feet that we're supposed to effectively deliver by the end of this year. Percent of that's pre-leased. Another 44% of that remaining has activity on it and active proposals. So, I think obviously development, delivering Class A buildings in irreplaceable locations has been our motto and our theme really from the beginning. And, some of that land's taken a long time to get through entitlements. There's another big tranche that's in some form of entitlement that's still coming online. Again, irreplaceable location, and trying to put in, that truly highly functional Class A asset on a Class A location is our main goal. So, I think it's one of those interesting dynamics and interesting times where it changes. I mean, capital markets have sort of opened up a little bit, as we've seen over the last 3 to 6 months. We don't know how long that's going to be the case, but there is an appetite both on the buy and sell side. And so we sort of feel like if the environment is there on the buy side and the numbers make sense, we should be doing that. And if we're struggling and, things are tightening up, maybe that's the time we should be selling. So in a good market, we obviously, the whole point is to grow and take advantage of every opportunity we can on the buy side, and for our investors monetize on the back end as well. And there's, we're big enough and we're active enough on both sides that we really should be always buying and selling along the way.
Last question on that. Are you buying land still?
And I would say we're still evaluating locations, and we had a couple that went to investment committee here this last quarter. Land's a little bit tougher. Land actually hasn't really repriced much.
Yep.
You're still, with construction costs the way they've gone, with cap rates that have expanded, tied to just returns overall, you haven't really seen that price change yet on the land side. So it's a challenge. If you're an owner user, it's a different story, but for institutional ownership to come in and deliver the yield they need and to break ground, it sort of talks to that stalemate that we currently have. Now, if rents go up 30%, I think you'd find a lot of people being a lot more interested in land, but there's still just enough uncertainty around where cap rates are going to be. And we talked about this even whenever it was last time we spoke, that like we got to have a little bit of clarity. I think there sort of is, and we know sort of where we're going to be long term. I think we all still feel very positive about rent growth on a go forward, but we are in sort of that uncertain period where, if you could buy either a great, well located building, whether it be mark to market upside or a tenant in tow, that probably is a little bit better risk profile for us today than buying a piece of land that need a couple of years of entitlement, or, if it's already through that phase, you're already priced in that, that upside. So
it's a really great point. And it's hard for us too, because over the last 2 years, you've had so few land trades. It's hard to really put together an opinion of value to bring something to market. The comps are still, pretty much 2 years ago, right? And beyond. So to try to go to a seller and, provide updated pricing with really no comps is tough. And then of course, buyers, construction prices or construction interest rates have gone up, from 3 to 9% ish, right around there, right? And they have an expectation that land has come down, but we haven't seen that. And so you're right, there's still that disconnect between buyers, sellers, and where is the value.
Yeah, and I think, from our standpoint too, like we really believe in the location of our land. So again, if you're talking about, a site in a tertiary market out next to the next cornfield, we don't really own a lot of that. Not really our MO, but at the end of the day, we own irreplaceable locations, and we're designing buildings that we intend to go spec with. And, we've definitely picked up our efforts on build-to-suits and have had some really good progress on that front where, a lot of times these groups don't necessarily need a cookie cutter box or some component that needs to be changed. So, we've got, just because we've gone through the entitlements, the fact that we haven't started pouring slabs or tilting walls, we actually have the ability to go in and modify those site plans. So, we've spent a lot of time with our large occupiers and are actually making some really good progress the first half of this year, whereas before it was always just, we're just going to build spec, whether it becomes some sort of spec to suit along the way. That's certainly happened in the past, but there's definitely more of an internal effort to come forward with a tenant on some of these land sites that, today are just a little bit more challenging yield wise, just based on the overall cost.
Yeah, well, it sounds like you guys are really as active as you've ever been, kind of on all fronts, which is great. You always have a really good pulse on the marketplace, especially when it comes to,
You do.
the occupier side of the business. So really appreciate you sharing your insights on kind of what you're seeing first half of 2024. I agree with you that I think that, 24, there's going to be more velocity across the board, tenant side, investment side, development, all of it. So we'll all look forward to that. And thanks again for joining us and for sharing your insights with us. You were great as always.
Yeah, you
Thanks,
got it, guys.
Brandon.
Thank you for having me on. I really appreciate it.
You bet.
Yeah, you.
Thanks, Brandon.